Welcome everyone. How are you, Gustavo?
Great, and you?
Good, good. I think
Very
this is
excited
like the
for
first.
this episode. Very excited for this episode.
Congratulations on being a second time father. By the way, I think this is your first podcast as a two-time father. So
Well,
hope you
he's
can keep
five
at the
days
pace.
old. He's 5 days old. Let's go there.
Hope you don't fall asleep during the conversation because of lack of sleep.
Definitely. We have a very interesting guest now.
So who's our guest, Gustavo? Since you know him much better than I do, just feel free to introduce us, our guest, because I think this is. I mean, we usually say that our guests are special, but I guess this time it really means it.
Sure. We're now inaugurating a season of big LatAm VC investors, and now we have one of the founding partners of LatAm VC, Eric Asher from Monashees.
How are you, Eric?
Fine, thank you. Thanks, Jaime. Hi, Gustavo. Congrats on being a second time father. I didn't know that. So that's
Thank you.
great. Great to be here. Thank you very much for the invitation.
Yeah, he told me, Eric, that he hasn't slept since last Wednesday. So that's why I said I hope he doesn't pass out during the conversation at some point. So let's try to keep it entertaining, even if it's just for Gustavo.
Let's
So,
do that.
Eric, before we get into the Monashees, LATAM in general, and other topics, I mean, take us a bit through your background. What did you study? Where did you grow up? And how your professional career developed all the way to what you're doing now.
Sure. So actually, I was born and raised in São Paulo, in Brazil. So I did my studies, school and college here in Brazil. I basically uh, didn't know what to do in college. I ended up studying geology for a couple of years, of all things, and then economics. So I was a dropout of two kind of courses, geology and economics. I ended up studying, advertising was another thing that I did, and then I did business administration. So I was kind of generalist from the beginning. Very very
Did you
curious about
finish
several
any of
things.
the degrees? Did you finish any
I,
of them?
f- I finished undergrad. I finished the advertising school actually, and then I did a postgraduate diploma in business, and then actually I my first professional experience was at McKinsey. In Brazil, when McKinsey opened their Brazilian office in the early '90s. Nobody actually knew what, strategic consulting was not a thing, and McKinsey was very small in the region. But it was, it was a great thing that happened because I really liked that experience, the opportunity to work at a firm like McKinsey, for a few years. Then I ended up going, for an MBA and I was very much involved, also because of my kind of advertising background. I ended up working with marketing and consumer industries. I ended up going to Kellogg at Northwestern. So I did my MBA at Kellogg and returned to McKinsey in the Chicago office of McKinsey. And I actually never, saw myself as doing consulting in the long term. But I mean, it was an incredible experience. And actually through McKinsey, I got in touch with my other relevant experience before founding Monashees, which was working for General Atlantic (GA). So not many people know, but actually GA was founded by ex McKinsey's
Hmm.
in the 1980s, and through the McKinsey network. I learned about GA, and I always liked technology very much. Um, and I was very interested in technology. I was interested in investing. Didn't know very much what venture capital was at the time, but GA looked like a great place to work. They were looking for somebody to open their first office in Brazil. This is back in '99, and so I joined GA and opened a small office, small place at Regis here in São Paulo in 1999. The dotcom boom, everything was happening at the time, and right after that, came the Nasdaq crash. So it was good to start my investment career with a crash. So it actually taught me a few things about market cycles and tech cycles. And so
Yeah,
that was my experience before Monashees.
it's like people started investing in 2021 before the whole 2022
Exactly,
boom.
exactly.
Couple of questions, Eric, on something that you said. One is you said that the experience at McKinsey was very good or for you professionally. In what sense, and what did you enjoy the most, or how did you learn the most? And I'm asking this because I mean, oftentimes in our industry, the tech industry, I mean, there's this whole debate about the value provided sometimes or not by investment, so strategy consultants and stuff like that, or the McKinseys and the big fours of the world. How was it instrumental for the development of your career?
It's a great question. I think the experience at McKinsey was, the opportunity to see different problems, different industries. Every 3, 4 months, 6 months, you'd be involved in a different, kind of a challenge. I mean, that gives and ends up giving you kind of a great view about how things work and connections between different businesses, different companies, different industries. So it's a very intense experience. So in 2, 3, 4 years you end up seeing a lot of different things, whereas if you're working for only one company, you see the same subject year after year. It's good, it gives you more depth, of course, but it doesn't give you that breadth of experience. So this is one thing. The other is teamwork. When you're working in a company like McKinsey, you have to work with different teams, with different managers, different consultants, different client team members. So you're every few months you're involved with different teams. You have to learn to work with different people, different styles. It also gives you this importance of teamwork and importance of working with with different people, which ends up being critical in anything that you do. Um, it of course develops your kind of problem solving, problem structuring, communication skills very much. So these are the good things. Of course, there are the things that as you get closer to you know operating businesses or being involved with you know uh, problems like in venture capital. Of course, consulting ends up being more theoretical, a bit more academic, more detached from the problem. You give a recommendation. In the old days, now I think it changed a bit, I don't know, but in the old days, I mean, it was about giving a recommendation and going to the next thing, not being involved that much in implementation. And of course, when you're operating a business or when you're venture capital, much closer to the operation of companies, not involved in the operation, but closer to that. You need to develop a different set of skills.
And how would you say that transitioned you to General Atlantic? What were the main differences and the main similarities?
Well, GA actually has been founded by ex McKinsey's, in my view, had a bit of that, kind of being a very, very analytical approach to investing, and very and having a deep understanding of industries, of industry cycles, of the industry structures. GA is very strong in that, and I think that comes from the McKinsey kind of DNA, in my opinion. But of course, GA developed into a different, very successful firm. I have a lot of admiration for it, and my years at GA, I think, proved to be a great place to actually prepare me, to the challenge of founding Monashees and building Monashees. But I think that in that sense, I think the analytical approach is a very strong characteristic of GA. The other thing that actually in either kind of investment world, be it private equity, growth equity, or venture capital, is similar in the sense that you're kind of have to be multi-channel and multitasking all the time. So you're involved in different deals, different situations, different companies, and you have to be good. You have to enjoy that. Some people, I mean, it's a bit of a vocation, to enjoy that. Some people don't like it. Some people like to be very focused, and it's great. I want to do one thing at a time for several years, build. Entrepreneurs have to be much more focused, and investors and a bit similar to consultants had to enjoy the this multi-channel kind of work. I like to say, venture or invest. It's a roller coaster. It's almost like a bipolar thing, in the sense that in the same day you can be celebrating an incredible great news or exit, and just have to deal with another company that is maybe not facing an easy situation. So, and you have to be able to navigate through these things. And this is a characteristic of these businesses. So another thing that's similar, between the GA experience. So in my years at GA, I was able to work in several different deals, all of them, on technology. So that was, where I learned a bit about technology. But also, maybe the important thing here is that at GA, I had, for the first time, contact with venture capital, because GA was agnostic, stage agnostic at the time I worked there. Today, I think it's more a growth investor, much larger tickets, and more mature companies. But when I worked there, GA used to do early stage too, and used to co-invest with the top Silicon Valley funds, Sequoia, Kleiner Perkins at the time, and a few others. And through GA, especially after the crash, I moved to New York and worked at GA there in the US. I had a chance to actually travel to the Bay Area, to Silicon Valley, and interact with those funds and learn a bit about that model, the Silicon Valley model of, high impact entrepreneurs using technology to solve relevant problems, with the help of venture capital as kind of long term capital partners from the very beginning, that were willing to support from the very early stage, run that initial risk, control their risk through portfolio diversification. So it's an incredible model that I was not familiar with, and kind of fell in love with it, and with early stage working with entrepreneurs. And that's where the idea for Monashees and VC in Brazil started.
What were those days like post crash of? Because I guess, I mean, I've heard many stories, as we were talking before hitting record on podcasts and different interviews, about how the U.S. market was post crash, dry of money, and very few opportunities. What were those days like, and has that in any way, I mean, impacted the way you operate still today, Eric, and the way you're, for example, going through the current correction, not crash, but correction? I mean, oftentimes whenever I listen to other more senior people talk about lessons learned about around investing, they often say that you have to go through a downturn or crash or correction to really know what you're doing, whether that's investing in stocks, investing in as a VC, investing as a private equity firm. What were those days like?
Well, those days were, in a sense, similar to today, and we have several phases that were similar to today. Today we're going through a correction where you have scarcity of growth capital. There is capital for great companies. There will always be, but the bar is higher. There is, not a lot of opportunities for liquidity. So liquidity and fundraising become more difficult until you normalize the market and get to the next up cycle and the next positive phase of the cycle. But it's an incredible vintage, an incredible time to invest. So the top investors, especially in tech and early stage, you don't stop investing, because great companies are built anytime, in good times and correction times. And especially in correction times, you have less competitive, fewer competitive pressures and more access to talent. And so it's even, a better vintage. So this vintage tends to be a very positive vintage if you compare to other moments in the past, in the early 2000s, for example. So it becomes a kind of a bit of a strange time. There was, this this gap of 2 or 3 years where things kind of stopped a bit, but great companies were built, or were accelerated during those days, and like it's what's happening right now. So as they say, like the history doesn't repeat itself, but it rhymes. There are some similarities between this crisis and the 2000, or this correction and the 2000 correction or the 2008 correction. So it has to do with the market cycles and the tech platform cycles. So it's similar. We have to go through that. I think in a way, it having gone through that phase early in my investment career, um, I when things were actually booming in the last few years, before the correction, we were very focused at Monashees on pursuing liquidity. So I think we were able to get, good liquidity events. We could have had more. We could have focused even
Always.
more, but always, as always. But I think we ended up doing a good job. Just in that time we accelerated a bit too much, the pace of investments, but we also pursued a lot of liquidity that was good because and it's very important in Latin America because it returned several times our first funds and kind of proved the model because it was the you know we're still in the first cycle of venture capital in Latin America, so there's still a lot to happen. This first generation of companies, we're still going through that, and now we have to go through the correction. So learning about the cycles, I think it's critical, and as you mentioned, in any segment of the kind of investment world, but especially in venture capital.
So how do you see those cycles? I mean, you are always talking about the Patterson cycles. Could you talk a little about that, and how do you see it playing out in Latam?
Well, of course. I mean, we met, throughout the years, and as we built our network, especially in Silicon Valley and other regions. But we met, great great people that we admire a lot. One of them is Arthur Patterson, the co-founder of Accel, which is also a venture firm we have a lot of admiration for. Great co-investor partners. We've been co-investing for the next 10, 12 years. And Arthur Patterson actually has um, this theory about the Patterson cycles, which is actually something that's very insightful about the tech world. So the tech platforms, digital tech platforms are built, and I'll try to summarize here, my view on that. But, tech platform cycles last around 15 years, or had lasted around 15 years. And platform cycles actually are built over each other, on digital technology. So starting with semiconductors, end of the 1950s until early 70s, and then the PC cycle, 70s to 80s, and then the browser, internet cycle from the mid 80s to the 2000. And then in the last 20 plus years, we've been living the social, local, mobile, broadband, cloud cycle. But these cycles are actually built over each other, and these technologies. And at the end, of this 15-year period, usually you have a correction, a market correction, that can be a bubble that can explode or can deflate, and sometimes it actually, kind of coincide with a market cycle, also a correction, which we believe it's this case now. Actually, the winner companies are built. It's in the first phase of the cycle. It's hard to know what will be the next technology platform. In the second phase of the cycle, it becomes more clear, and then winners are built. And then at the end of the cycle, there's a saturation of businesses being built over that tech platform, and that actually contributes to the end of the cycle and the correction. The fact that it's a 15 or has been a 15-year on average, and this one was longer, I can tell you more about our view on that. But the fact that it's more of a fixed time, had been a fixed time, over cycles of 15 years, is related to the fact that it's a human cycle. It's a human, entrepreneurial cycle. So you can't accelerate that, even though you have the more, acceleration, that technology is accelerating exponentially, but to build companies and to grow companies is a human cycle. You cannot accelerate too much that. So that's why it takes like around 15 years. And in this cycle, I think it has been a very unique cycle in the last 20 plus years, because the first, uh, it's the first global cycle. The previous cycles had all been kind of built in Silicon Valley, and not even in other cities in the U.S. They were, most companies were in Silicon Valley, and this cycle had kind of echoes of the cycle in different geographies, in China, in India, in Southeast Asia, in Latin America. So it became a different cycle, longer because of that, but not only because of that. Also, we had this phenomenon of the tech enabled companies. So before, venture capital was actually investing basically in technology, pure technology companies. Tech companies that were very scalable, high margin software companies. And in this cycle, basically, you know, as I think Mark Andreessen said, software is eating the world, and it really is eating the world. Um, so every company became kind of a tech company, and tech just became, the online to offline, and delivery networks, and all the other companies that are using technology, but for businesses that also have a big component in kind of real life, non-digital life, and this also actually expanded the the types of companies that were receiving capital from venture capital investors. Of course, some excesses were done, and some companies that shouldn't have received received capital, or at valuation that didn't make sense. Multiples were applied where it didn't make sense. So we all know the story. But the fact is that it really expanded from a more niched, pure tech segment to tech enabled. The third thing is that this cycle, the previous cycles had a more kind of focused one technology kind of platform. And this one, you had, social, mobile, the launch of the smartphone, local commerce, but also you had, data, the
Cloud.
data, cloud, broadband, so many different technologies. So it was more sophisticated cycle that also created, a longer time. The other thing that it was unique to this cycle was, and I think started probably with Facebook, is that because of I'm talking about the tech aspect, but of course there was the economic phase of the cycle of the low interest rates and abundance of capital, which was also a very important element. But this abundance of capital also made an acceleration of tech, made a lot of investors look and say, hey, out of FOMO sometimes, just say, hey, I want to invest in this, tech thing is great, and a lot of capital actually ended up being invested to try to capture the alpha before IPOs. So the
Hmm.
period between the first venture rounds until IPOs was also longer, because investors were trying to invest and give more runway to companies to grow before IPOs. In previous cycles, I think the IPO was a natural phase of the cycle, for the company. It happened around, I don't know, around 4 years after the first venture round for the top companies. And in this cycle, it was stretched maybe to 6, 7 years, in some cases. So it also contributed to stretching the time. And the last point on this cycle, of course, this is it can be a one conversation only about that, but also the what happened is that because of the abundance of capital, you probably heard this number: 2/3 of all the capital invested in this 14-year bull market, that happened since 2008 until 2021. 2/3 of the capital invested globally was invested by non-VC investors. So you're talking about hedge funds and crossover funds and asset managers and corporations and family offices, investors that didn't have an experience with venture capital and didn't really had the experience with VC cycles. Historically, this number used to be like 20, 25%. And now in this cycle was two-thirds, 60, 70%. So it also brought a new type of capital that now in the correction is probably going to take some time to get back, or only in the next up cycle part of this capital will be back. So now we in this correction we are we have the we're back to normal in a way. So what the exception was those years of this kind of extreme bull market that we saw. But we can't complain in Latin America, because when we talk about Latin America, this actually helped establish the LatAm VC industry, and so ended up having a role on that.
Fantastic. So I have the cycles here for our listeners to know. So you have the semiconductor cycle. Correct me if I'm wrong, please. But from
Yes.
1955 to 70, you have the PC cycle from
So,
70 to 85, the browser
yep.
wars from 85 to 2000, then the social local mobile from 2000 to I don't know around 2020,
To today.
2021. Now the next cycle. But let's pick a list. So let's go back in time a little bit. So you founded Monashees in 2005. Then you
Yep.
experienced head on this last cycle in LATAM. How was that? How was going from General Atlantic to establishing a venture capital company in Brazil in 2005, which I wouldn't even say is the early innings of venture capital in LATAM, probably a little in the warm up phase.
Oh
Um,
yeah.
and then
We
experiencing all this bull market, the region coming up, the founders picking up, very good successful stories. How was that?
No, it's been an incredible journey. I mean, um, I basically, when GA decided to move away from early stage investing, and also take a pause on Latin America, because there was nothing really happening here. There was a little bit that happened in the late 90s, but then there was a long kind of nuclear winter, from 2000 to 2009 in Latin America. So because of that, with GA making that decision, I decided to move back to Brazil, and nobody was looking at venture. I was really excited about it. I had this conviction that technology was accelerating, and with that acceleration, venture capital was going to become a global industry. So that was, of course, there were very early signs at that time. A little bit in China, a little bit in India starting up. So you could see that that was going to happen, and it was just a matter of time until Latin America also became the target of this entrepreneurial revolution
Mhm.
because of the acceleration of technology. And so that was one conviction. The other conviction was that Brazil and Latin America were going to be a very fertile ground for this revolution. Huge entrepreneurial energy, great entrepreneurs, great, very talented people, and a lot of inefficiencies to be addressed by entrepreneurs using technology. So it was going to be a fertile ground. And the third conviction I had was it was going to take time. I had studied a bit the Silicon Valley VC model, and in Silicon Valley, successful funds actually take around 10 years to establish themselves. It doesn't happen overnight. Of course, you have some cases of outliers that just get the first investment was a great investment, and in a few years they establish themselves. But the norm is that it takes around 10 years. So I knew it was going to take even longer here, and that was key for us to be prepared. For me and for my co-founder Fabio Igel, that when we started, he was an active angel investor too, and passionate about helping entrepreneurs. And so when we decided to start Monashees, we knew it was going to take. Um, our estimation was 15 years, and ended up taking that time. To really to prove Monashees and to prove the industry. It was around that time. The first 5 years, as Gustavo mentioned, we always joke about it. I mean, we started running the marathon, 5 kilometers before the starting line. The market the market really started in 2010, and it started early. But in a sense, I think that's why we're here today, because we had time to warm up, we had time to make mistakes, we had time to learn, we had time to build our network. That was very important when the market started. And then when it started, I mean, we were almost the only fund with around, and then other funds, of course, other good funds also started around that time after 2010, and we all kind of helped build the industry. But growth capital only really started after 2015-16. The first, I think, the first mega round in the region was 99 in 2017, and Rappi around the same time. And then between 17, 18, and 21, I mean, then we saw a lot of capital flowing to the region. But that first generation of companies that was built between 2010 and 15, 16, these entrepreneurs were heroes. They built their companies without a lot of capital, incredible capital efficiency because there was not growth capital available. And then we had this phase of the so there were different phases. First 5 years for us, not a lot happening, and then a phase of building the first generation of companies without growth capital, and then a lot of growth capital, and now the correction.
So if we slice this up in the three phases that you mentioned, in the first phase you have the Wall IPO in 2005, the Mercado Libre IPO in 2007, I
2007,
believe,
yeah,
which I
yeah,
mean it's an amazing story.
amazing story,
And then you have Naspers buying Buscapé in
yeah,
2009.
yeah,
And then you have the beginning of these big companies that took off in 2014, 2015, 2017,
mhm,
culminating with the 99 exit, which is a
yeah.
story we're going to approach later. So, this first phase, would you say it was about creating inspiring stories for these second stage companies to be founded upon? How was experiencing that firsthand?
It was incredible because we saw those, you mentioned some key events. We were following those key events because even though there was nothing happening in the first 5 years, and I can say at least we're happy to say that, not happy, but I mean it's good that it happened this way. No great companies were founded between 2005 and 2010. And I say that with relief because we were there trying to find, if there were a lot of great companies that were built in that time, we wouldn't have done our job. No. So it really nothing happened. But at the same time, we saw the signals. We saw the Mercado Libre IPO, as you mentioned, and the other IPOs. Google acquiring a company in Brazil called Aquan in 2005-6. Then there was the launch of the iPhone in 2007. So we were seeing, and then China was growing. China in 2005, the whole of China was VC market was $1 billion. $1 billion China in 2005. So it was almost non-existent. Of course, it's a lot of money, but for China, it's very small. And so I think China, I don't know, broke like 100 billion in the last few years or something like that. Before all the changes in China too. But anyways, I mean, we saw the trends, we saw the signals, and that's what kept us going. Because if there was nothing happening on all fronts, we could have said, "Hey, I mean, we made a mistake. There's nothing happening." But we saw the signals, and that we continued to build, and waited until 2010. So actually, when I mentioned the first generation, that generation started in 2010. I tend to consider, the first real VC investment. I mean, in a company in Brazil, first collaboration between a Silicon Valley VC and a Brazilian VC was Peixe Urbano in early 2010. That we co-led the Series A with Benchmark, and that I think is a very important milestone for the market because this is a company founded by Julio Vasconcelos that today became an investor at Atlântico in Canary. And he was a repatriate Brazilian that had experience in Silicon Valley, one of the very few. And other foreign entrepreneurs also moved to Brazil to start their companies. And that was instrumental. That was very important to change the culture of the relationship between entrepreneurs and investors at the time. Because when we started, I think one thing we observed also, the lack of venture capital, true long-term partners of entrepreneurs, like a true VC must be, is that in Brazil and Latin America, all the bargaining power had always been in the hands of the investor. So investors always used that bargaining power when they invested in entrepreneurs and ended up like controlling companies or diluting or squeezing entrepreneurs because they didn't have a VC mindset. They had more of a transactional investment mindset. So, and that created over the years, even in the first cycle of the late 90s, but it created for entrepreneurs this perception that investors are here to actually, they are kind of against me. And the history of conflict between entrepreneurs and investors was a very difficult cultural change. When we started in the first years, we used to do the Silicon Valley kind of type of term sheet, minority participation, a fair, but even sometimes a bit generous valuation in early stage, um, some protections, but all the control and the management was for the entrepreneur. So when our first term sheets, I remember very well, we would give out the term sheets and entrepreneurs would read and call their lawyers to read the term sheet and they say, hey, so you're investing in me, it's a minority position, you don't have any controls. Hey, where's the catch here? Where's the catch? It's too much to be too good to be true. That was the
Fantastic.
culture, and so it's very not a lot of people talk about this, but the fact of the Brazilian repatriates like Julio that I mentioned, and the foreign entrepreneurs that understood venture capital, they helped change that culture. They were much more open to build a relationship of trust with the VCs, and that's where things really started. And so I can mention, of course, there was uh, Fabian from Logi, or Florian and Mati from Printy at the time, Brian Reckord from Viva Real, and many others. So I think, or the guys that started baby.com.br at the time, Kimball and Davis. So there were many stories there, and that was very very important. But why did that happen? I think it's important to mention. Actually, there was the financial crisis in 2008. U.S. and Europe were still facing that crisis, and that crisis initially didn't really hit Brazil that much. Brazil was surfing the commodities wave and growing, and Brazil was the last of the BRICS countries that was not didn't really attract a lot of attention, and because Brazil was growing and investors wanted to look for a new geography to invest. So Brazil popped up on the radar screen and popped up on the radar screen of Silicon Valley for the first time. And so that combination, and also foreign entrepreneurs said, hey, Brazil is an interesting country, it's a large country. Let's start our new companies there. So that combination of factors actually made the industry take off in 2010. Also, the Buscapé deal that you mentioned, end of 2009. So that combination of factors made Brazil become the first kind of tech hub of Latin America, which, in my opinion, actually, the country that really was the hub in the first cycle and could have been the hub in the second cycle was Argentina. The Argentina has incredible entrepreneurs, incredible tech talent there. But unfortunately, in Argentina, it looks like macro problems got in the way, and there was some
Hmm.
kind of brain drain, and they were not. I mean, they continue to have incredible companies, but I mean, as the largest tech hub in Latin America, then Brazil had this opportunity to take off before the other countries.
Completely agree. Completely agree. So, getting one of the stories that to get the Monashees story here, let's get 99. So, 99 was founded in 2012, sold in 2017. It was, I would say, is the poster child of this first wave in venture capital in LatAm. I want to know your opinion that you got this story firsthand, you experienced it head on. How was that creating the first LatAm unicorn?
And what did 99 do? Just to for listeners who don't know the company.
Sure, 99 was the one of the ride-hailing companies um, in that started in Brazil in 2012, as Gustavo said. At the time of Uber was growing. Uber, I think, was founded in 2009. Was not in Brazil yet, but was growing very fast in the US and a few other countries. And then actually a high number of companies, these waves, like it happened with Peixe Urbano was a daily deals company. We had the daily deals wave in 2010 with Groupon and others. And then there was the wave of ride hailing companies. There were several kind of taxi hailing companies. This was before peer to peer, kind of independent drivers. So companies were focusing on taxis and really kind of giving access to taxis. And we spoke we met with all of them. There were many companies. But when we met 99, which was founded by, Paulo Veras and Ariel and Renato, I mean, incredible combination of a more seasoned entrepreneur like Paulo Veras and young tech talent, Ariel and Renato. We fell in love with the team. We said, hey, they had the right strategy because the other players were trying to. There were players at the time that they were giving out smartphones to drivers, but the smartphone was locked, so they could only have that app from that company. Some crazy things, or they were actually charging the drivers for part of the ride, so creating a relationship of being kind of a place that or a company that the drivers had to pay for. So the wrong strategies. And 99 had the right strategy. It was about reducing the frictions for drivers to really join the service. And then we invested in the seed round of 99 in 2013, and then co-led and then actually continued to invest in the Series A with other investors. And the company grew very much, but in the taxi segment, because the peer-to-peer was not still like a lot of questions about peer-to-peer at the time.
Mm.
But then Uber entered the market in 2014. So this is an interesting story. Lots of ups and downs. But the fact that the reality is that as I mentioned, there was no growth capital available for companies still in 2014. So 99 had to kind of struggled to fundraise a Series B. Actually, raised the Series B with Tiger, if I'm not wrong, and then needed more capital to compete with Uber and launch the P2P, the peer-to-peer, which independent drivers, and Uber coming with infinite pockets. So it's very incredible work that was done by the 99 entrepreneurs. Incredible, amazing, because they, without access to capital, they basically turned the company profitable and growing and profitable. I mean, it was an amazing work. And that work caught the eye of Didi, which was actually competing with Uber in China, and also of SoftBank before SoftBank launched the LatAm Fund. This is SoftBank from the International SoftBank Fund, and then so Didi and SoftBank invested in 99. Then in 2017, when 99 was already kind of had turned a profit, and a large round, and 1 year later, 99 made the offer to acquire. Didi made an offer to acquire. And so in 5 years, build a company from scratch to little over 5 years to $1 billion exit, the first $1 billion exit, the first $1 billion company in the region. A true milestone. And some of our LPs and more experienced LPs, they told us, they said, now you will see, what happened in other regions and other geographies, that this is going to raise the level of ambition of Brazilian entrepreneurs and Latin American entrepreneurs. And it really happened. Because right after that, you saw companies even bigger and bigger with bigger plans and bigger ambitions and more capital flowing.
And what were the learnings there? The good and the bad learnings, because I'm gonna later jump to the other the other poster child of the following wave, which is Rappi, founded in 2015, and that begins the whole LatAm expansion of Monashees. But what were the good and the bad learnings of the 99 deal that made Monashees see that the seeds it was planting since 2005 were going in the right direction?
Well, there are many, many, many learnings, of course, but I mean, I think not only 99, but several other companies I can mention. Um, the fact that I mean, it's learnings that are important for this phase of the market. Probably one of the most important is that during that time in 99 is an example, as I mentioned, but there were others. Um, these companies the founders had to have, the successful ones, had to have a capital efficiency mindset. Just do more with less, even in good times or bad times. It doesn't depend on, oh no, well, now there's good times, I don't need to have capital efficiency. You always need capital efficiency. And so 99 is one example. I mean, when they needed, they were using that capital, even from the Series A, Series B rounds, they were using in a very efficient way, and then they turned profitable at a time that growth capital didn't exist. So I think the big learning for us as a VC was that the importance of capital efficiency mindset at a different time, because there has been a lot of companies that were created during the boom years, and a lot of VCs that were created in the boom years that haven't been through that. So we were fortunate that we had those like 5 years, and we observed that because we made some mistakes. We also invested in entrepreneurs that didn't have a capital efficiency mindset at a time that there was not a lot of capital to actually support them, and they didn't succeed. They don't exist anymore. And I think so. We saw that difference, and it helped us. Of course, not that we continue to do a portfolio diversification and made some bets here and there. So it's not that we apply this 100% of the time, and sometimes we continue to make a mistake here and there. But in the last few years, this is something that we prioritize in our conversations with entrepreneurs, because even in bull market years, we always tried to see if the founders have that capital efficiency mindset, how they're going to use the rounds. I know it sounds like something very basic, but you have to go through it to see the difference.
How do you try to judge that at an early stage when you're talking to the founders, that
Well,
capital efficiency?
you have today, it's easier than before because today you have a whole generation of proven or experienced entrepreneurs. So when you have proven or experienced entrepreneurs, you can learn a lot about their mindset from their previous experiences and previous learnings.
Hmm.
Uh, it gets more difficult with first-time entrepreneurs. We continue, of course, to invest in first-time entrepreneurs. I think it's important. They bring a fresh perspective, but it's a bit harder to judge. But you can, in the conversations, just seeing, where they come from, their plans, their vision. VC in the end, after talking to thousands and thousands and thousands of entrepreneurs and seeing these patterns, it's a pattern recognition business in the way that you learn to recognize those patterns. It doesn't give you, the guarantee that it is this way or the other. But I think in the conversations and looking at their previous experiences, you can have a good idea of that.
And would you say there are some specific patterns throughout LATAM that there are in the US or other regions?
Specific patterns, you mean?
Is a more capital scarce region, more
Oh,
recent
yeah.
region?
I think entrepreneurs here in the region are incredibly talented because the type of risk that we face here is more of an execution risk. It's not a region yet that is driven by innovation risk. Right? We're working to get in that direction. I think we see more and more innovation. We see more and more local innovation, and we start to see global innovation coming out of Latin America. Our dream, of course, is to help entrepreneurs become more and more global innovators and build global companies. I'm sure we will get there step by step. But most of the opportunities today actually are more like, inspired of, by similar companies that in other geographies and executing in Latin America. And executing in Latin America is more difficult, but in compensation for that, in our opinion, competition risk or competition pressure is lower. It's not like, in the US. I mean, it's kind of easy to start a company and you innovate, you do something, and next day you see there are 20 companies doing the same thing that you do, and some are much better than you with more capital than you. It's a different type of risk. In Latin America, our observation is that when you have the best team and you have access to capital, it ends up discouraging a lot of competitors. Of course, there are some segments, especially now in the last phases of this saturation of the tech cycle, that you see some segments that became more competitive and you have several companies pursuing, but it's localized. I mean, overall, I think you have usually one or two major competitors, so the competitive pressure is lower. But the execution pressure and the execution risk, because it's a it's an environment that is complex. You have complex kind of tax structures, complex laws, quality of services. Until recently, tech talent also was more scarce. Today, we're really filling that gap, but it's harder to execute. So, but Latin American entrepreneurs are, they have experience, navigating through all these kind of roller coaster of uncertainties that we have in the region. And that actually is the old saying, kind of rough seas make good sailors.
We have an advisor in the fund who is Sergio Furio, and he always mentions that you have to be a wartime CEO every time to be an entrepreneur in Latam.
Oh
You
yeah.
don't get to be a
Oh yeah.
peacetime CEO for even a couple of months.
Yeah, I agree. I agree with him. I agree with him. I think that's a characteristic of the region, but where it's also where the opportunities are. Each region,
Certainly.
I think, has its own
Yeah.
their own profiles.
So going on to the next story, which is an amazing story, going to the Rappi deal. I mean, we were talking about international expansion. Rappi made a tremendous expansion throughout LATAM, and Monashees is part of that. Uh, it was a company built on in a scenario where you had growth capital in the region. How was that different from 99?
Yeah, so 99 was 2013 that we kind of led the seed round, and Rappi was 2016 that we met the Rappi entrepreneurs, Simon and Seba's incredible, amazing entrepreneurs. We met them when they were raising the seed round. We heard about them. We were basically focused on Brazil, but we were starting to hear great things about that were happening in Colombia and Mexico, and it just was a natural kind of expansion for us to start investing in other countries in the region. And then we
Because
we
up,
heard
up
through our
up until
network.
now, up until that point, Eric, you had not invested outside of Brazil, so that was the first deal.
We had made a couple of investments in Argentina because Argentina was more of established tech hub. So we made a
Hmm.
first investment in Argentina. I think was 2009, if I'm not wrong. So we had a couple, but it was not a big focus. I think the Argentina was more about, hey, let's go to the you know to see what's happening in Argentina, since Argentina was so significant for the first tech cycle starting in the late 90s. But it was not kind of a pan regional LATAM strategy. So uh, in the case of Rappi, our partner Carlo D'Apuzzo, that actually was our first associate, started in the very early days with us, and is a general partner at Monashees. He was actually looking. He actually led the the 99 also deal. Uh, and so he was involved more in mobility, logistics, and delivery networks spaces. And through his network, actually, he learned about Rappi. And I was actually in San Francisco, and he called me one day and says, "Hey, I heard about this great company, Rappi. They are raising a seed round. It's happening as we speak. So maybe we should try to go to Bogota and meet with the guys." And I have to say that until then, we always, I mean, because the market was not that developed, we always like to take our time and get to know entrepreneurs for a few months or at least weeks, so you get to know them before it's a long term partnership. And Rappi was the first one that actually challenged that model because we were in the middle of a very competitive round, and we learned about, we had monitored Rappi, but we didn't know they were raising so fast. So I was in San Francisco. I changed my flight and I went straight to Bogota, and Carlo went to Bogota, and then we met with the founders and spent the whole day with them. We were introduced to them, and it was a great, great day. I mean, of conversations, getting to kind of to meet them and see what they were doing. They were very small at the time, only in Bogota, but you could see the traction. You could see their level of ambition and their how talented they were. So we made a very fast decision in the case of Rappi, and that became our first kind of investment outside of Brazil with that kind of pan-regional vision. And and the good thing about Rappi, besides being an incredible company with incredible founders, is that it became an amazing hub of entrepreneurs. So both Simone and Sebastian, they actually they see Rappi, and they like the fact that Rappi is actually training new entrepreneurs that can at some point leave and start other companies. I mean, you see some other founders that reject that idea. We know, and it's fine. I mean, there are some founders that don't like that. They don't want to lose anybody. Oh, it's a talented person. I want them here. I don't want to lose. I don't want them to go out and create other companies. We know a few, but in the case of Rappi, I mean, from the very beginning, they were very open to that, and it's amazing the number of companies that were created by the what's so-called Rappi Mafia. I mean, that we see in the region today.
That's amazing. And by the way, one of the key KPIs of Monashees that we like is how much sourcing you get from these mafias, like a proprietary sourcing.
Well, the hub mapping, I think, became something that we learned over the years. Doing this what we call this lineage analysis of deals. Because after when you see like thousands of deals over the years, we can map what was the first email, the first WhatsApp that actually who recommended which company, and when you put all these things together, you end up seeing some hubs, clear hubs where the good deals come from. And after some time, you see where the good deals come from, where the deals that are not so good come from, and you start to see the hubs and map the hubs, and that becomes a very important analysis. But of course, you need the data. And today we see, I mean, in the old days, the hubs ended up being kind of the large tech companies, Google or Stanford, academic hubs. Or we would have to go out and see first-time entrepreneurs that actually were doing something interesting out of the radar screen. That was more of the early days. Today, it really became more of a hub. Angels became hubs, and um, large tech companies, successful tech companies, and successful entrepreneurs became hubs like 99, like Rappi, like Nubank, and several others. And so it's become a very important part of what we do to map these hubs in real time, anticipate who will be the next hubs, but also build those relationships, because that when you build those relationships of trust with the hubs, you become kind of a natural kind of a natural potential kind of partner for the entrepreneurs of that hub.
And with all this organization, I was thinking about when you were talking in the beginning with the McKinsey and General Atlantic story. We just met Sebastian in Mexico City a couple weeks ago, and I was thinking when you talk about McKinsey, we don't talk about James McKinsey or Marvin Bauer. When we talk about General Atlantic, we don't talk about Chuck Finney. We always talk about the firm. And
Yep.
we are in a very, very personalistic and individualistic industry. And when you talk Monashees, you don't talk about specific people, but you talk more about the team. And it always feels like when you talk to one or the other person, you have very, very similar values and principles and a very deeply ingrained culture. Um, how did you manage to do that? And how is that going through your LATAM expansion with the Mexico City office, with the expansion of the LATAM investments after Happy and then Walla and go forward?
It's a great question, Gustavo. I think from the very beginning, I think this was uh, just kind of a natural, spontaneous. Was not a strategic decision. It was just a natural, spontaneous um, kind of value that we had. Both Fabio and I, as co-founders, that we wanted to build. Uh, as you mentioned, a few examples. We wanted to build, and we want to build a long kind of a long-term platform, built to last. Monashees is bigger than all of us, and should be kind of this place where we all have our common principles and values, but not being individual partners that have their deals. And the way, of course, we structure our carry pool, it points in that direction, and other incentives. But mostly on the day to day. I mean, we have we are six partners today, and um, so I mentioned Carlo D'Apuzzo. There's also Marcelo Lima that joined in 2010, and Caio Bolognese joined us in 2014. And the only partner that joined more recently is Guto Araújo, but actually Guto was an entrepreneur in the portfolio. Today he's our operating general partner, and Guto actually was co-founder of Elo7, a company that was acquired by Etsy, one of the very few Latin American tech companies that was acquired by a world class kind of international US tech company. So it's an incredible case too. So and then Guto, after the exit and the acquisition of Elo7 by Etsy, we invited Guto to join Monashees in 2020. And Guto, so we know Guto for 10 12 years now. So even though it's new to Monashees, we've been together for many years. So this is the way we're building, and we also have our principals. Rodrigo Aldrighi and Sulien, they joined in 2015, and more recently Fabiola Quinzanos, that is our principal in the Mexico City office that we opened last year. She leads our Mexico City office. So we have actually now, um, and of course we have the senior associates and the associates and the analysts. We have a team in the investment team, a multi-generational team that we're building in a way that we have the several generations working, which is very important in venture capital to have different generations working, and also thinking about planning the long term of Monashees. The what you mentioned, I mean, we understand, and it's fine. There's no right and wrong, but we understand that, especially in Silicon Valley, some of the firms are more about, oh, you received an investment from firm X. Yeah, but who's the partner? It really depends on the partner. Totally different styles, totally different. It can be a totally different firm depending on the partner that is leading the deal. And we believe in having one team, one set of core values and principles, as you mentioned, and that everybody kind of is aligned. Everybody has, of course, their own experience, their own style, but I'm glad to hear when I hear, like you mentioned, that when you talk to different people at Monashees, you can see this. What there's a lot in common about the team. That's the way we've been building the
And
firm.
what are some of those core values, Eric, that you can share with the audience that you think shapes both the firm and also probably, I mean, those of you who founded the firm?
It's interesting because we talk a lot about them. We don't have them totally kind of structured and designed in a way that there's a training about that. But I mean, I can say that we are, we always say that we are, we're very uh, pro-founder, and we want to be always aligned with the founders, and think about the company first and the founders first, and having that long-term partnership. uh, it's about being, we believe a lot in what we call more of a Socratic methods of, the founder is actually has to be, just managing his company, and we're there to help. We're there to challenge. Of course, we have our, we can be very firm in our opinions and discuss with the founder, but always with a lot of respect, and recognizing that he's the one that is not diversified. Investors are diversified, and that creates a big difference that needs to be understood and well respected. So we believe a lot in what we call kind of, you know, uh, human values first approach to investing and to working together, and in the way we treat and respect people, and leadership team members and founders and our whole team. Um, of course, there are the principles of excellence. There are the principles of just doing always our best. Um, and there are other principles in communication, being active listeners, being engaged. There are many others, but I mean, we believe what we do, as we say, I mean, what we do is similar to other VCs. I mean, we think we try to differentiate ourselves naturally, not by design, but naturally by how we do things and our style.
Yeah. I was just thinking that one of the I mean, we have very different types of people who listen to the podcast, but I think one audience that usually listens to the podcast that we don't usually have a lot of advice or tips for them is actually emerging managers or people that are building funds for the first time. I mean, you guys have been around for more than 15 years, so almost 17 or 18 years now. I mean, what kind of advice or lessons learned do you have around, besides culture, as you were saying, around building like a firm, not just a fund, but a firm that wants to continue into the future and have a legacy. And it can be stuff around portfolio construction, it can be stuff around price sensitivity when it comes to valuations. Uh, just like some key lessons learned that you have, Eric, after all of these 17 years, for those who are listening, who are either thinking about launching a fund themselves or have already launched but are in year 1 or 2, as you were like in 2005, 6, 7.
Sure. I mean, I don't think there's a formula. I think you can be successful in many different ways with different styles. I mean, you have to be authentic. I think that's the most important thing. Um, you have to be, I think, probably at the top of the list of things. If you want to get into, be an emerging manager and GP and venture, it's all about resilience and it's all about patience. It takes time. It's a long cycle, and you have to be aware of that. I think I see from time to time and over the 17, 18 years we've been around, we've seen many firms come and go and many teams trying to do it and coming and going. And in my opinion, most of the times they were great people and with very talented, but I think they sometimes lacked. I mean, they didn't have the patience, or they were a bit anxious. And I think uh, this is a business that you need to be patient. You need to be resilient. Um, the the other thing I would say um, is that, I mean, to you have to have a vision, on where you want to get. Uh, I like a quote I've heard once. I don't remember the basketball player that said, but it says, like, you don't get to be great accidentally. And I think it's a great quote. It's not going to happen just out of the blue. I mean, you have to want it very badly, and you have to work every day to make it happen. And for that you need a vision. You need to know, where I want to get, and how I'm going to get there, and how I'm going to differentiate myself. One thing, at least for us, I mean, in VC, I think early stage VC tends to be, at least, of course, you have some global niche sector investors, but I still think that, I mean, kind of our model, the Series A generalist VC, I think it's a proven model over decades, and I think it's a great model. I think the temptation is to try to be kind of a tech specialist or a sector specialist, and just to understand everything about a certain sector of tech. But that gets to be very hard if you want to be a generalist. You cannot know everything about everything. In our opinion, from our experience, to be a good VC with time, you have to be a specialist in entrepreneurs, and I can't emphasize that more. So you can we of course we have our thesis, our points of view about sectors where things are going, but this is only to train our minds to be prepared, to understand the real opportunities that are being kind of um, identified by the entrepreneurs. Actually, what we have is an advanced post that see the deal flow and we see where things are going. And of course, we need to understand that. But the true trailblazers that are understanding what where the best opportunities are, at the right time, are the entrepreneurs, are the founders. So our mission is to actually try to understand and recognize who the best founders are, because we see a lot of good founders, but we need to really see who the best ones are, and then be there to help them in any way we can, and also be prepared to be there. Some VCs may think differently, but I mean, we are partners for the good times and for the bad times. I mean, you have to be there for the roller coaster. Not only, it's easy when things go well, it's easy to be a partner. I mean, you have to help in the challenging times too.
And for the founders, who are also a big part of our audience, what would you say, especially given today's circumstances?
Well, it's understand, I mean, what it means to be a founder. Again, top of the list, resilience, top of the list, patience, um, and understand. I mean, if you want to be a founder, an entrepreneur, if it's the first time, you may not get there in the first time. But I think maybe one of the really big things that we changed culturally in Latin America in the last cycle, 15 years, is that the stigma of failure. And nobody talks about it anymore, in tech at least. But when we started, I mean, the stigma of failure was huge in the region. So, you would talk about, people would talk about entrepreneurs. I bet he tried that and didn't go well. So also, like, if that was a stigma, which doesn't make any sense. So I'm so glad that we helped, together with all the other funds and entrepreneurs, change that, because it's if you fail the first time, just you learn and just continue. I know this is kind of a cliche in our world, but that's true. I mean, and there was a big obstacle in the region culturally, like it was a cultural obstacle when we started. We like to say that when we started, we used to go to all the major top schools and universities to talk about venture capital and entrepreneurship, and we used to put 100 students on the room and ask, so who wants to be an entrepreneur? And nobody raised their hands. Nobody, not a single person, for years. Because to be an entrepreneur at that time was either crazy or you don't have a good offer. Um, and it changed. Even if you discount the hype and everything that happened, even in the correction, today, a lot of young, talented people, they want to be entrepreneurs or start their careers working for a startup or a new tech company where they can learn. And so, for founders, I think if you don't have an idea, work for a company until you get the idea for what you really want to do. I mean, that other point, don't. Um, it's all about fall in love with the problem and not the solution. I mean, that book, I mean, it's always very important to say, because we see a lot of founders that also kind of passionate about the solution and trying to fit the solution into a problem that sometimes doesn't exist. So it's really getting identified with the problem that is relevant. If you want to build something big, has to be a very relevant problem. And the last thing, choose very, very well your co-founders and your partners. Um, Choose very carefully, because that will define the culture of your company. You don't design the culture of your company. The culture will be a natural expression of the values of the founders. And so you have not, don't pick only brains or people that have a kind of a expertise on something. Choose human beings, and your company will be, a result of that.
Super cool. I was actually thinking that it's super curious and interesting how unmature technology markets, despite the distance, can be so similar in certain characteristics. Because many of the things that you just said, Eric, I think could apply to the Spanish like startup ecosystem like 5 to 10 years ago. So fear of failure, which is more like a cultural thing, market control by investors in a way. So I think it's super interesting how that appears in many different ecosystems despite the distance. So before we get into the last two questions, or to get into the last two questions, can you recommend us a book, Eric, or some other content? It can be startup related or not. It can be a movie, it can be a newsletter, it can be a publication. And can you also suggest someone to invite to the podcast who hasn't been on before?
Sure. Well, in terms of a book, I mean, there's so many. It's very hard to talk about books. I think it may be, it's a book I think from 2021 that, uh, but maybe it's already outdated. I don't know, but it's interesting. I love science fiction. I really think that whoever works with tech, in the end, like to say, venture capital is kind of short-term science fiction. Yeah, but I mean, science fiction just is such an interesting exercise reading science fiction. To exercise this kind of openness of the mind to innovation or the implications of new technologies. Um, so I think an interesting book on AI, that it is the big thing today to read, at least a good summary of where things may go. And it was written in a different format, was 2041. 2041 is a book written by Kai Fu Lee and Chen Chu Fan, that actually is like, I don't know, 10 short stories, uh, but each short story has some kind of explanation on where AI is going, 10 implications of AI, that you have a short story. And actually, the stories are not the big thing. The great things are the explanations of the technologies, that where AI is going, in the context of that short story. So I thought it was an interesting book. I mean, to reflect on what's happening with AI, even though it's already kind of a couple of years old, which these days it's a big time. So I think it's an interesting book for what's happening today. In terms of a person to interview, I think an entrepreneur I admire, and from our conversation had a very important role in the ecosystem, is Paulo Veras. Paulo was the co-founder of 99, but he was an entrepreneur before. He also was the head of Endeavor before he was, with 99. And so he's been kind of being a very important kind of actor in the development of the entrepreneurial culture and the tech VC industry in the region. So I would recommend him.
Awesome. We'll ask for an intro if Gustavo doesn't know him, for sure. Eric, this has been super great. I know you don't do this kind of stuff very often, so we really appreciate it. So thanks a lot for your time, the insights, and the lessons learned. Because I think it's been a pleasure to listen to you.
No, thank you very much, Jaime, and thank you, Gustavo. I mean, this was a pleasure, great conversation. Thank you, very insightful questions. It was great to have this conversation with you. Thank you very much.
Okay,
Thank you. Amazing
have
episode.
a good one.